Common size analysis is a technique used in financial statement analysis that transforms each line item in a financial statement into a percentage of a selected base amount. The purpose is to simplify comparisons both over time within the same company and between companies of different sizes. In the income statement, every item, such as cost of goods sold, operating expenses, taxes, etc., is typically presented as a percentage of net sales or total revenue, and the balance sheet, items are shown as a percentage of total assets, or sometimes total liabilities and equity. This method is called common size because it standardizes all figures to a common scale, allowing meaningful comparisons regardless of the company's size or currency. It's particularly helpful for comparing financial statements across different years or companies in the same industry. Let's say a company has net sales of $1 million and a cost of goods sold COGS of $600,000. In a common size income statement, COGS would be shown as 60% of sales. Another company may have sales of $10 million with COGS of $6 million, also 60%. Although the numbers are vastly different, the cost structure is the same. This makes common size analysis a powerful comparison tool. Common size analysis performs several important functions in financial analysis and business decision-making. Allows standardized comparison. It removes the effects of scale, enabling analysts to compare companies of different sizes on an equal footing. Whether a business earns $500,000 or $50 million, common size percentages level the field for analysis. Reveals structural composition. It helps analysts understand how a company allocates its resources. For example, if 30% of total assets are tied up in inventory, that might raise concerns for a company in a fast-moving industry. Tracks internal changes over time. By applying common size analysis over several periods, known as horizontal common size analysis, companies can track how expense categories or asset allocations evolve, identifying positive or negative trends. Supports ratio analysis. While financial ratios focus on relationships between two figures, common size complements them by offering an overall view of all line items in relation to a single base figure. Simplifies financial presentation for internal reporting or communication with non-financial stakeholders, e.g., marketing or operations teams. Presenting financial data as percentages can be more intuitive and easier to understand than raw numbers. Common size analysis offers a range of valuable benefits for both internal and external users of financial information. One of the main advantages is that it enhances comparability by standardizing all financial data into percentages, making it easier to compare companies of different sizes, or to benchmark a company's performance against industry averages or competitors. This standardization is particularly useful when comparing companies with different scales of operation, as it shifts the focus from nominal values to proportional structure. Another important benefit is its ability to highlight financial trends and irregularities over time. By converting line items into percentages, analysts and decision-makers can quickly detect changes in cost structures, revenue composition, or asset allocation that may otherwise go unnoticed in absolute figures. This allows companies to identify areas of concern, such as rising expenses or declining profit margins, at an early stage. Common size analysis also aids in identifying potential financial red flags. For instance, if a company's operating expenses suddenly increase as a percentage of sales, or if liabilities begin to take up a larger portion of the balance sheet, these signs may indicate inefficiencies or growing financial risk. Furthermore, this analysis improves the quality of decision-making by offering clearer insights into cost management, resource allocation, and financial planning. Managers can use these insights to evaluate whether operational costs are aligned with revenues and to assess whether assets are being used effectively to support business growth. Another significant advantage is that common size analysis helps strengthen internal financial control. By monitoring financial statements regularly in common size format, businesses can ensure they maintain healthy cost structures and balance sheet proportions. Finally, common size analysis is accessible and easy to understand, even for non-accountants.